Hi everyone, welcome back to the Brick and Mortar Podcast by Hubexo. Today I'm excited to sit down with Hue Chen, who leads Saglo Companies, a firm that has been owning and operating shopping centers across the Southeast since 1976. Hue has been with Saglo since 2012 and has an abundance of experience in retail real estate. We'll dive into Saglo's long-term investment strategy, the role of data in acquisitions, and how macroeconomic trends are shaping the industry. Don't forget to like, share, and subscribe to the Brick and Mortar Podcast to stay up to date with the real estate industry and hear more from industry experts. Hi, Hugh. Thank you so much for joining us today.
Thanks for having me. I know we've been trying to connect for a couple months, so this is great that we're actually able to do it now.
I know you've been so busy. Can you tell us a little bit about yourself and what you do?
Sure. So I'm Hue Chen. I'm president of Saglo Companies, and we own and operate shopping centers across Florida, Georgia, and we just expanded into the Maryland market a few months ago. We've been around for a long time. We were founded in 1976 by a gentleman named Saul Glotman. And from 1976 until today, we've been primarily focused on retail shopping centers. My history is that I started in commercial real estate in the year 2000. I worked at companies that are more South Florida based, such as Terra Nova Corporation, Woolbright Development, and Ram Realty. And I've been at Saglo since 2012.
Wow, that's an incredible journey. Let's get into Saglo's journey. So the company has been around a long time, almost 50 years, and you've been a part of its growth for almost a decade. What initially attracted you to Saglo, and how has the company's investment approach evolved?
Yeah, you bring up a great point that we're going to be nearing our 50-year anniversary next year, so we'll have to figure out like a really good event to do, or we'll have to put my head together with David, our director of marketing, to figure out how we're going to celebrate it. But it is quite an accomplishment. I would say the majority of companies don't have that type of tenure, and that history or that track record and the tenure is one of the reasons that attracted me to Saglo. I think like in most businesses, I think that the track record is one of the most important things that you can look at. And especially one that's been through 3 or 4 or 5 down cycles. Because look, I think it's I think that in up cycles, anyone can be successful, and it's not as difficult. I think riding out these down cycles, now that's really where you cut your teeth and sharpen your skills, if you will. And it's interesting because 2012, when I started at Saglo, is an interesting year, since that's coming off the heels of the great financial crisis. And when I had met with Jack Glotman, who's the son of the founder and the main principal at Saglo, he wanted to do something a little bit different at Saglo, because from 1976 until 2012, it's been essentially all of the Glotman family's equity powering the growth of Saglo. And the portfolio size fluctuated, between 600,000 feet and maybe just under 1 million square feet. And it's been growing slowly, low leverage. But the idea was that, hey, maybe we can really scale up and expand or increase the footprint of our portfolio size by bringing in outside investors, perhaps friends and family investors, and then instead of owning 100% of the properties, maybe keep 10 or 20% of the property of the ownership of the properties, but just have a lot more of them. And so I came on board in 2012 for that purpose. So the tenure, the track record, and also the opportunity to really, grow the company. I think that's all things that excited me. And to grow the company, you need to have a strong capital base. And so I think that their conservative nature up until then allowed them to have, a good amount of capital to really roll out an expansion plan. And to this day, which is one of the unique things that we do, is when we're buying properties and then raising money, we are actually our largest investor in all of the funds that we create. So that's another unique thing about Saglo.
Nice. So, another unique thing that stands out about Saglo is that while many firms focus on ground up development, your strategy is centered on acquiring existing shopping centers. What's the philosophy behind that approach?
Well, when you look at investing in real estate and any type of real estate, whether it's ground up, whether it's existing, and whether it's retail, multifamily, office, or industrial, you're evaluating what kind of return you could potentially get and have gotten. And that's the track record, and the amount of risk that you think you're going to be taking on or have taken on. I think that when you're doing ground up development, you're taking on a lot of additional risk, because when you're starting that type of project, you're not seeing any type of income for at least a few years. And there's a lot of variables that you are dealing with the ground up that you don't have to deal with as much when you're buying existing properties that are income producing. A few of them are the municipal risk. When you're trying to get a zoning change or plans approved for ground up construction, that time and even the potential approval or disapproval from the municipality, that's a huge variance, and that's a risk factor. Then and on top of that is the interest rate risk, because when you're doing a ground up, you first have a construction loan, and then when you finish the construction and your tenants are open, you replace that with a permanent loan. And when you're doing your underwriting, you just kind of assume, hey, well, maybe the permanent loan will be 5% or 6%. Or maybe it's 7%, but you're kind of guessing, and the amount of time between that underwriting and actually locking in that long-term debt can be years, and it's very hard to predict what the interest rate will be in that time period. In addition to that, then you have inflation risk, which is when you're starting to think about constructing a property, you have a budget that you're working with. But over the period of a few years, in normal times, inflation's 2-3%. But as we've seen in the last few years, you only have so much control over that. So in some cases, if inflation was very high, you could be constructing for much, much higher than you thought you would. So I think those risks would, if I were to take those on, I'd want to get a much, like a very strong, maybe twice the return that I would get if I were to just buy an existing property and fix it up and lease it up and, increase the NOI. When we looked at it, we haven't been able to find ones that we can make that much return. So because of that, we haven't done the ground up, and we prefer to do the existing. Plus, when you're buying an existing property and you put your long-term financing on a day one, you start cash flowing right away. And the type of investors that we have really, they invest with us because they enjoy that type of cash flow. 3 months after the fund closes, they're getting checks, right? Distributions starting the first quarter of their investment.
Yeah, that makes a lot of sense. Many investors view real estate as a hedge against inflation and market volatility. Do you think shopping centers still are a strong investment in today's climate with inflation, interest rates, and the cost of capital?
Well, the good part of inflation, I guess, would be that your replacement. So if you already own property and you bought property for below replacement cost, which is the essentially all in our entire portfolio would fall in that category. If there is a lot of inflation, your cost to build new property just goes up that much more. So that in itself kind of creates a little bit of a moat in that you're not going to get a lot of new product coming online competing with your product if that's the case. So if your supply growth is limited, and your demand continues to grow up at a steady pace, then that helps out everyone that already has property. So I think when you look at it from that side, that's pretty interesting. When you look at it from the side of interest rates, usually if there's a lot of inflation, assuming that the unemployment rate is not too high, the natural response from our central bank, from our government, would be to increase interest rates to try to, temper that inflation. Which is interesting because, when you increase the interest rates, historically, I don't know about historically, but I think there is some loose correlation of having the cap rates also go up, because no one likes to buy with negative leverage. So if the cap rates go up, then we're able to buy more property at a little bit higher cap rate, higher yield, and so that's good for us also. That hasn't been the case the last couple of years. So it's been a little bit of a strange capital markets period, but I think that may come to fruition this year. And then when it comes to inflation hedges through the income stream itself, meaning that the tenants, what the tenants are paying, the great thing about retail is that these are triple net leases. So meaning that when you're billing the tenants, you're billing them the base rent. That does not include the expenses. And then you're billing the expenses separately. You're billing the real estate taxes, the insurance, and then the CAM, all as separate line items. So if those items go up because of inflation, then you're able to pass those expenses through to the tenant, who then needs to increase their prices as well, because I'm sure that they would be experiencing inflation not just from rent but also from their cost of goods sold. So that inflation hedge is very interesting. You do have to be mindful, because some of these national credit tenants, and there's some very desirable tenants, they're going to put caps on the increase in their CAM, or they might have a fixed CAM that doesn't increase at all. They might have a fixed or no increase in their base rent. So when you're looking at a rent roll, if you have too many of those tenants that have fixed CAM or fixed base rent, then you may not be able to take advantage of inflation until you have the rollover opportunity that allows you to bring those rents up the market. So like a great example would be some of the bankruptcies that have happened in the past few years. Kmart and Sears have been around for 50 to maybe 100 years, and I think that some of those leases, because I remember I had a Kmart lease. I mean, there's no rent increase for 47 years, because they locked in that rent when they signed it in the 1990s, and they said that's it. This is the rent, no increases. And it's like, sometimes you want to have some of this turnover to be able to access the ability to bring your rents up to market and take advantage of that inflation.
Yeah. So over the years, Saglo has expanded strategically, entering Atlanta in 2018, and now you're looking at the Mid-Atlantic region. What factors make a market like Maryland or Georgia attractive for Saglo's long-term vision?
So I'll give you the short answer of that is that we really look at 2 to 3 mile communities, because our shopping centers that we buy are neighborhood community centers. So we're less looking at the states and the cities. We're more looking at the communities. And there's great communities in Florida where we operate, and there's also poor community, not like poor investment communities in Florida as well that we wouldn't want to invest in. They don't have the fundamentals that we're looking for. So we'll kind of start with that. And then the question would be, as we were trying to grow, if I don't have as many opportunities presented to us in Florida, at that point, should I look in other states like Georgia? And the answer was yes a few years ago, and that's why we expanded there. And then we said, well, if it's very tough to buy in these 2 states because they're high growth states, very high demand, a lot of people are trying to buy real estate in Florida and Georgia, so that pushes the cap rates down. Can we find yield somewhere else? And so really it's driven by yield, but also with the understanding that, we're really buying into communities and neighborhoods. And there's great communities and neighborhoods like in Carroll County, Eldersburg in Maryland, where we just bought Freedom Village. We love that area. I mean, it has a great story of employment drivers, of income, of population growth, and the intersection that the property is on is the retail node. And then one of the property that we bought before that was in Melbourne, Florida, and that had all of those same aspects: strong employment drivers, population growth, and income. And we're not afraid to look at even other markets like Ohio, Pennsylvania, and the Carolinas, Kentucky, Tennessee. But we look at the neighborhood itself. One other part of it that I didn't talk about is that we do need to be able to get to it fairly easily, since we are pretty hands-on. So I prefer direct flights from either Miami or Fort Lauderdale, or both, preferably. And that way, if we need to get up there in a moment's notice, we can jump up there.
I'm interested to hear about the differences between Miami and Atlanta in terms of investment dynamics.
Well, Miami, ever since COVID, has kind of been labeled like, and maybe even before COVID, but it is a global tier 1, investment grade city. Now it's like you got, some of the deepest, biggest pockets in the world putting flags down in Miami and wanting to own a part of Miami. So
even with global warming,
that question has come up a number of times, and I would say that there are some institutional investors that do think of that. But that being said, there are so many that are comfortable with the data that they see, that they are not pulling back and investing in Miami. Additionally, there's a like a theory that usually innovation comes from your need. So there could be some technological innovation that helps, sturdy or strengthen the resiliency of the real estate and of the urban landscape of Miami that might come about in the future as we need it.
Okay. Sorry, I interrupted.
And on the Atlanta is an amazing market. I think it's like the busiest airport in the world. I think Atlanta Hartsfield, and there are so many companies based out of Atlanta and so many different industries. And for a long time, it was very affordable to live there, and I think it still is, relatively speaking. But certainly the secret's gone out, and there's been a lot more people moving to the Atlanta market. So as population growth has got employment drivers and industry, and we really like that market. And plus, it's very easy for us to get there from South Florida.
It's interesting to hear about how Saglo chooses its market. So I know that data plays a big role in your decision making, and you've mentioned using Placer.ai for acquisitions. Can you walk us through how that technology helps guide your investments?
We were a pretty early adopter of Placer AI. I want to say that we were maybe one of the first 10 customers that they had. And when we were presented with what they were trying to do, it immediately resonated with us, because at the end of the day, you're trying to figure out when you're making an investment within a shopping center. And so we use it for two purposes. We use it to acquire properties, and we also use it for leasing purposes. And I'll explain the two options. I think on the acquisition side, it's a little bit more straightforward in that the data that is the most important would be actual tenant sales data, meaning that, how much does Publix generate in gross sales out of that one particular location, or it could be Chipotle or any other retailer. And that information is not readily available anywhere other than for that retailer. And so, and oftentimes, sometimes they're required to report to their current landlord, but oftentimes that they're not. And so that's important, because when you're making an investment of a property, you're making an investment for the cash flow that the property generates. And then you're trying to figure out how durable is that cash flow. You know that the cash flow is durable if the tenants are doing well. And you know that tenants are doing well because of the sales. In the absence of sales, what else can you rely on? Well, in the past, maybe you just went to visit the property, you looked at how well stocked the shelves were, or maybe you just stood in front of the doorway and just counted how many people went in and out. But that's very, rudimentary and a little bit, I think there's better ways of doing it. And that's where Placer comes in. So until Placer came on the market, and they used the geofencing, I think, what is it called? Like spatial data, geofencing data. I forgot the exact term for it. But
geospatial mapping?
Geospatial map, there you go. So before that came about, it's like, for you to figure out how many people went to a certain area and for them to run the analysis, it may take like a week or something like that, and you're paying per report. They made it self-service. They made the user interface really, really easy, and you can use, and it was an annual subscription instead of like per report. So the ability to get a little bit of insight, at least on the footfall traffic of one store compared to other stores, was something that, while not perfect, gave us a lot more insight than not having anything at all. So that's kind of how we came to kind of really embrace Placer. And since then, they've become like a unicorn, $1 billion company. So I think a lot of people also have seen the benefits of having the Placer data.
Yeah. Apart from foot traffic and sales, are there any other data points you analyze before making an acquisition?
Well, I think that kind of going back to the Placer, and going back to what I said about investing in communities. We look at the community, we look at the trade area, but a new term, or not a new term, but I guess a term that's easier to define now would be the true trade area. Where does this property actually draw from? When I started 25 years ago, you'd look at the map and look at your artificial barriers, such as highways and train tracks, and then your natural barriers like rivers and mountains. And you'd say, hey, this river kind of splits this market into two, and in general, people stay on their side of the river, or they stay on their side of the train tracks or highway or whatever. And then you kind of look at where the other retail nodes were, and the radius analysis was very popular. Okay, it must be a 2-mile radius, but oftentimes it's not a radius. Oftentimes it's a very different shape, and there's no way for you to determine that until you have this type of geoplacing data. And so I think really hyper focus on that trade area, and then once you defined it, then now it's looking into what's the supply demand statistics there. What's your retail per capita, meaning what's the income, what's the population growth, what employment, where do those people actually work, and drive time to work, but also are there employment drivers bringing more people to that area. Then I look at the utilization of the land itself, because when you're buying the real estate, you're buying the building and the land, and sometimes in some cases the land itself's worth more without a building on top of it than with one. It's unencumbered. So I look at new developments nearby, and something specific about retail is really the leases themselves. The retail leases are vastly more complex and I would say more onerous onto the landlord than really any of the other major classes. With apartment leases, there's really no negotiation. You're often docu-signing it, and it's very commoditized. With office and industrial leases, there's some more negotiation there, but it's not to the level of retail, because with retail, part some of the clauses that you don't find in other leases would be, for example, your co-tenancy clauses, which means that if your certain key tenants were to move out and you don't replace them in time, that tenant that's remaining, their rent goes down to 50% or some lower amount. And then there's use restrictions where you're not allowed to lease to certain types of uses at the property without their approval. Then there's, could be no build areas and things like that. So I think that those kinds of clauses are heavily negotiated that are absent in the other classes. And you have to really understand it, because if you have too many restrictions on the property, then your ability to relet it, if you're to get a vacancy back, might be really diminished, and then you might have to kind of mark down the rent because of that. So we pay close attention to that. Another thing would be the CapEx that's been done at the property, the age of the roof. The roof costs have really increased quite a bit, and also the parking lot. The cost to repave a parking lot is pretty expensive too. So those two items we really look into. And then we talk with the leasing associate with the property, and also other leasing people within the market to get a real understanding, because we're oftentimes, we don't live there, and figure that out. Then it gets to the basics: the rent roll, rollover risk, profit and loss, historical P&Ls, and year-to-date profit and loss, and configuration of the property, the spaces themselves. You want fewer elbow spaces. You want a nice configuration of the property so you have easy access and visibility.
Okay, nice. So every region has its nuances. How do you see primary versus secondary markets performing in the current environment?
Yeah, no, I see what you're saying. So I think that it's kind of interesting because COVID did a lot of interesting things, and when COVID hit and there was the shutdowns, it was interesting because a lot of people moved out of primary markets into secondary markets because of remote work, right? So you had a ton of people move out of New York into Austin because of remote work. Probably better Los Angeles to Austin, and then maybe from New York to Palm Beach or something like that, or New York to, I don't know, like Tampa. And so when you're looking at primary markets and secondary markets, historically, it's been that the primary markets are a lot more liquid, meaning that, if you wanted to sell, or if you want to sell, you oftentimes you're doing an exit analysis, especially if you're not holding too long of a term. How easy is it for me to sell it? Well, it's going to be super easy to sell a property in Miami because there's a huge demand, because it's a primary market, let's say, compared to Pensacola, which is a tertiary market. And that being said, because there's so much demand, it really pushes down your cap rate, which pushes down the yield. So once you own it, if you bought it for a lower yield, now you're going to be making less money per year unless you increase the net operating income for that property. So you have to do a little bit of lift that way. But that being said, you probably have more demand for the vacancies themselves in a primary market, because a lot of the retailers that are expanding, they look at primary markets first. And so you do have a higher demand for leasing, and maybe you could push rents. That being said, there's only so much rent that a tenant can pay. So the advantage of being in a secondary or tertiary market is that you're buying it for below replacement cost. You bought it for a good basis, and you can afford to do a cheaper rent. And maybe that becomes more sustainable, during down cycles. If you're paying a $80 a foot rent versus a $20 a foot rent, perhaps there's a higher likelihood of that higher rent paying tenant, going out of business. You kind of saw that a little bit on Lincoln Road, where the rents got to like $200-300 a square foot, and it kind of there was a down cycle, and things cleared out a little bit. So I just focus on probably liquidity, the demand for the spaces themselves, and you're probably getting a little bit better debt on the primary markets as well.
Makes sense. Do you think suburban shopping centers are becoming more attractive than urban retail spaces?
Well, I think it's cyclical, right? So urban was very, very much very popular from was it mid 2000s. There was a flight from suburb to walkable and things like that. And then during COVID, there was a kind of a move to suburbs and even exurbs. I think that's like further out than suburbs. I think a great place to be in would be first ring retail. So, you want to be close enough to the downtowns that it's not too inconvenient to get down there if you need to do business or, go to a show or something like that. And maybe you don't want to be you want to be far enough away so that you kind of get out of the pandemonium a little bit. That's from a, living standpoint. As far as investing, it's two totally different asset classes. When you, or it's the same asset class, but two different sectors within the asset class. So when you're looking at urban, you don't have common area often. You're not dealing with a lot of landscaping and parking lots and things like that. You're not dealing with probably as much co-tenancy and use restrictions, because if you're on Lincoln Road, a lot of times the ownership's fractured, meaning that the store, you have 10 stores adjacent to each other, but that might be 6 different owners. When you're dealing with suburban, it's very different in that you got a lot more land that you're dealing with, which is good because you own a lot more land, but then you have to really maintain it. And there's operational factors that go into that.
Yeah. You've been in commercial real estate since the 2000s, and you've worked with some major industry names before joining Saglo. Looking back, what's the biggest lesson you've learned about long-term success in retail real estate?
Well, I think that having a good track record is so important. I think that being well capitalized, meaning and having a good track record, not taking on too much leverage, and having the relationships to get the deal done. I think in all of the places that I worked at prior to Saglo, and they're all successful and continue to be successful, they've all leveraged those attributes to really propel their business forward, and also to get the best talent, because it's a people-driven business, and I think that people like working at places that offer them stability, that offer them security, and also have been around long enough and to have the processes kind of nailed down. And then for you to be able, they also want to be places that are growing. And for you to be able to grow, you need to have those relationships, and you need to have that capital as well.
That was amazing advice. If you were advising a new investor or CRE professional entering the retail space, what would your top piece of advice be?
Well,
Same thing.
I have so many. I have so many pieces of advice. Well, if you follow me on LinkedIn, you would know that I have this whole series of advice to students.
Yeah.
So
it's
some
amazing.
of the, yeah, no, I appreciate it. So some of the advice I would have when you're saying breaking into CRE is that let's start with like looking for the job itself. I would say that I got a little bit lucky because I had a great mentor in my first job, which was Beth Azor at Terra Nova. And I can't tell you how important it is to have an awesome mentor from the very beginning. And I didn't make a lot of money my first year, but I had a great mentor. But over the course of 25 years, that paid for that opportunity cost of making money, and having a better mentor in place of making money has paid for itself 100 times over, 1,000 times over. And so I think that sometimes if you're right out of college or something like that and you're looking at options, as you're getting interviewed, you need to interview the interviewer and find out who exactly are you going to be working with, and are they a mentor? And maybe the question would be to that person, hey, out of all the people that you mentored, who are you most proud of and why? Because that question, while simple, how they answer it is going to give you a lot of insight on that. Secondly, take a lot of notes, because as you're talking to professionals, and even when you're getting interviewed, you got to take the notes. So often people coming into the industry aren't taking any notes at all, and they think they're going to remember it or something like that. You need a CRM. So the CRM is crucial, and then that kind of helps you maintain and foster those relationships.
Thank you. I'm sure everyone will appreciate that advice. Finally, looking ahead, what excites you most about the future of shopping centers and retail investment?
Yeah, this was that's an interesting question. I think that technology and evolution really, really excite me. And it's, and what I'm seeing now, and when I say now, I mean the last 10 or 15 years, is interesting, because what I'm seeing kind of cycles repeat itself, or not cycles, but just themes repeat itself. For example, when I was growing up in the 90s, I had heard of like the milkman that comes by and drops milk off at your front porch every week. And I'm like, oh, that's such an interesting thing, but that's never going to happen again. Hey, now we're getting whole grocery bags dropped off at your front porch every week because of technology, right?
Yeah.
And then, you think of like, oh, I watch these movies of these Western movies, and there's the old general store. And then, how did you shop before the barcode and the shopping cart? Is you went to the counter of the general store and said, hey, these are the items that I want. Can you bag them up and give them to me? And that went away, right? Because of the barcode, the shopping cart, whatever. Now it's like that's back with buy online, pick up in store. Now you go to Target and you go straight to the customer service and you pick up your stuff that you ordered online and you leave. So that whole, it kind of revolutionized and went all the way back around, right? And then you think of when you go to Europe and you go to the old town of Europe with the narrow streets that were built for pedestrian and horse traffic, not the automobile. And, as Americans, you go to the suburbs and you're always like, man, it's a sea of parking. It's just not, it's not as pleasant as Europe, right? But, and it's not here yet, but autonomous vehicles, that could revolutionize that all the way back where, hey, if no one actually needs to own a car, or you can have the car drop you off and then it park itself. But I think no one will actually need to own a car is probably more like it. Now you can build these cities and you can build these projects more to a human scale rather than a car scale. You see what I'm saying? Mm-hmm. And so then it goes back to that kind of old European urban planning. So mm-hmm. I see a great future.
I agree. Oh my gosh. Hugh, this has truly been such an incredible interview. For anyone interested in learning more about Saglo companies or connecting with you, where can they find you?
Saglo.com, SAGLO.com. We're actually redoing our website now, but they can visit our website and get plenty of information. Also, we're on LinkedIn, we're on Instagram, we're on mainly those two platforms. So you can follow me personally on LinkedIn. I'm very active there. So that's Hue Chen, Retail CRE on LinkedIn. And I'm happy to be on this podcast. And thanks for asking me great questions.
Awesome. Thank you again for joining us. I look forward to seeing how you guys continue to grow.
Awesome. Thank you.